95% of traders lose money, not because the market is rigged, not because they are not smart enough, but because the advice they were given was wrong from the very beginning. And the worst part? Most of that advice sounds completely logical. It gets shared everywhere. It gets repeated by people with large followings and confident voices. And nobody ever stops to ask whether any of it actually works. In this video, I am going to show you 3 specific pieces of trading advice that almost every beginner follows. 3 pieces of advice that are repeated endlessly across books, forums, YouTube channels, and trading communities. 3 pieces of advice that sound reasonable and logical on the surface, and that quietly, consistently, destroy trading accounts every single day. By the end of this video, you will understand exactly why each one fails. You will understand the psychology behind why traders fall for it, and you will have a clear, practical fix for each one. This is not theory. This is not me telling you to think positive. This is a breakdown of real patterns that show up in real accounts, and once you see them, you cannot unsee them. Let's get into it. Meet Marcus. He has been trading for about 8 months. He is the kind of person who does his homework. He read several trading books before he ever placed a trade. He watched hours of content online, and in almost every single resource he came across, he found the same piece of advice. Cut your losses short. Let your winners run. It sounded wise. It sounded like the kind of principle a disciplined professional would follow. So Marcus built his entire approach around it. Here is what that looked like in practice. Marcus would enter a trade. The moment price moved against him by a small, defined amount, he would close the position immediately. No hesitation. Protect the capital. Cut the loss. That part he executed perfectly every time. But when a trade went in his favor, he would hold it. He would sit with it. He would wait. Wait for it to run further. Wait for the big move he had been told was coming. Wait for the trade to reach its full potential. And here is what kept happening. The trade would go up. It would look promising. Then it would stall. Then it would start to pull back. Marcus would tell himself it was just a temporary retracement. He would hold. It would pull back more. He would hold tighter, convinced the move would resume. Eventually, the trade would give back everything it had made, sometimes turn into a small loss, and Marcus would finally close it. Exhausted. Frustrated. Confused. He had followed the rule exactly. He had cut his losses. He had held his winners. And yet after 6 months of doing this faithfully, his account was down close to 40%. He had dozens and dozens of small, neat losses, and almost no meaningful winning trades to show for it. He started to believe he was psychologically broken, that he lacked discipline at some deep level, that trading simply was not for him. He was wrong. He was not broken. The advice was incomplete, and incomplete advice, followed faithfully, is often more dangerous than no advice at all. Why it happens psychologically. When traders hear the phrase, "let your winners run," they attach an emotion to it. That emotion is hope. The trade is moving in their direction. They feel good. They feel like they are finally doing it right, and they do not want that feeling to stop. So they hold, and hold, and keep holding. Not because the trade is still valid, but because closing it would mean ending the good feeling. The market, of course, does not care about your feelings. It does not owe you a continuation. Trends pause, momentum fades, price reverses. And because Marcus had no plan for when to exit, no defined destination, he had no rational basis for closing. Every time the trade pulled back, his only framework was, let it run. So he did, until it hurt too much to hold any longer. There is also something working against traders here that psychologists have documented extensively. It is called loss aversion. Research has shown that people feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. What this means in practice is that when a winning trade begins to pull back, the trader feels that pullback as pain, real emotional pain. And that pain triggers the instinct to hold even tighter, to wait for the trade to come back, to not lock in the loss. But because there was no plan, there is no rational exit, just a hope that price will return to where it was. Sometimes it does, often it does not. And the result is a trader who technically followed the rules and still lost money. Think about that for a moment. You can follow advice perfectly and still get a bad outcome. Does that not tell you something about the advice itself? The fix. The fix here is not complicated, but it requires you to do something before the emotion starts, before you enter the trade. Not during, not after, before. You define a target, a specific, concrete level where you will close the trade if it moves in your favor. Not a vague idea, not a feeling, a number. You write it down before you enter, and when price reaches that number, you exit. Not because the trade cannot go further, not because you have given up on the move, but because you made a rational decision when you were calm and clear-headed, and you are honoring that decision. This is what professional traders actually mean when they talk about letting winners run. They are not talking about holding indefinitely and hoping. They are talking about a predefined destination, held to with discipline. The run has a finish line. It is not a marathon with no endpoint. You also need to ask yourself honestly before each trade, where does this move logically end? Where does price tend to find resistance? Where would a sensible trader take profits? That level is your target. Write it down. Commit to it. Then hold the trade to that point and close it. Not before, not after. Marcus eventually learned this. He stopped thinking about running and started thinking about destination. He stopped asking, how far can this go? And started asking, where does this specific trade end? His account started to recover, not because he found a new strategy, but because he gave a piece of old advice the structure it had always been missing. He was still following the same principle. He just finally understood what it actually meant. Now let me tell you about Daniel. Daniel is sharp. He is genuinely hardworking. He wakes up before the market opens. He reviews his watch list every morning. He tracks his trades in a journal. He reads about trading in his spare time. By almost any external measure, Daniel looks like a serious, committed trader. But Daniel has a problem that he does not fully recognize yet. He cannot sit still. When the market is open, he feels an almost physical pull to be doing something. Every hour that passes without a trade feels like a wasted opportunity. The market is moving. Price is constantly changing. Surely there is a trade somewhere in all of that movement. So Daniel trades. A lot. 8 to 10 trades on an active day. Sometimes more. He tells himself that this is how you practice. This is how you get better. This is how you build the experience that leads to skill. After 3 months, Daniel sat down and went through his trading history carefully. He noticed something that genuinely disturbed him. His best trades, the ones that had made meaningful money, were almost all trades where he had waited. He had seen a clear setup, taken his time, and entered with confidence. There were maybe 4 or 5 of those per week. Maybe 6 in a particularly good week. The other 30 or 40 trades per week, nearly all losers. They were small individual losses, nothing dramatic, but when Daniel added them all up, they were canceling out everything the good trades had earned, and then some. He had been working hard every single day. He had been doing the hours, putting in the effort, staying disciplined in terms of showing up, and his account was still declining. He was exhausted and getting nowhere. The problem was not effort. The problem was that Daniel had confused activity with progress. Why it happens, psychologically. Overtrading is one of the most common and destructive patterns in retail trading, and it is almost entirely a psychological problem, not a technical one. There are 3 things driving it, and they work together in a way that makes the pattern very hard to break. The first is boredom. The human brain is not designed for patient observation. It is designed to act, to respond, to solve. When you sit at a screen watching a market move and nothing is happening that meets your criteria, your brain does not interpret that as good discipline. It interprets it as missed opportunity. It starts looking harder. It starts finding setups that are not really there. It starts convincing you that this pullback might be the entry, or that this little consolidation looks like something. And you take a trade not because the setup was good, but because your brain needed stimulation. The second driver is something called the urgency to recover. After a losing trade, the brain immediately starts looking for a way to fix it. The loss feels uncomfortable. The account balance looks wrong. There is a powerful urge to get back in and make it right. But that urgency is emotional, not logical. The next trade that comes along while you are in that state is taken for emotional reasons, not because the setup is sound. And emotional entries almost always lead to emotional exits, which usually means another loss. The third driver is identity. Daniel thought of himself as a trader, and traders trade. Sitting on the sidelines felt to him like not doing his job. It felt passive. It felt like he was missing out. But here is the reality that most people never tell you. The best traders in the world are extraordinarily selective. Some of the most successful independent traders make only a handful of trades per week. They are not lazy. They are disciplined in a way that looks like laziness from the outside. They have learned that waiting for the right moment is not inactivity. It is the job. How many trades have you taken this week simply because you were bored or felt like you needed to be doing something? The fix. Daniel needed to do something that felt genuinely uncomfortable. He needed to trade less, not slightly less, significantly less. And he needed to build a structure that made that easier to follow on the days when the urge to trade was strongest. He did two things. First, he set a hard ceiling on the number of trades he would take per day. 3. Not 3 as a target. 3 as an absolute maximum. If he found 3 setups that genuinely met all his criteria, he would take them. If he found one, he would take one. If he found none, he would take none. A day with 0 trades was not a failure. It was discipline working exactly as it should. Second, he created what he called a permission checklist. Before entering any trade, he had to answer 4 questions honestly. Is this setup clear and obvious? Is my risk defined before I enter? Is this the same kind of trade that has made me money in the past? Would I be comfortable describing this trade to another experienced trader before I took it? If the answer to any one of those questions was no, he did not trade. No exceptions. No negotiating with himself. The results were almost immediate. His win rate climbed significantly. His stress during the trading day dropped. He stopped ending each session feeling drained and frustrated. He had more energy, more clarity, and for the first time, his account started moving in the right direction consistently. Not because anything about the market had changed, because he had stopped letting boredom and urgency drive his decisions. More trades is not more opportunity. More good trades is. And to find more good trades, you almost always have to take fewer total trades. That is the counterintuitive truth that most trading advice never bothers to mention. This third belief might be the most damaging of all, not because it is the most dramatic mistake, but because it is so deeply embedded in how people think about success that questioning it feels almost strange. It feels like questioning basic math. Meet Sarah. Sarah is methodical. She tracks everything. After 2 full months of trading, she sits down with her journal and goes through her numbers carefully. She sees that she has won on roughly 40% of her trades. She has lost on 60%. She stares at that number for a long time. 60% of her trades are losers. In any other area of her life, 60% failure would mean she needed to stop and completely rethink what she was doing. So that is exactly what she concludes about her trading. She starts second-guessing every entry. She changes her strategy repeatedly, sometimes week to week, searching for one that produces a higher win rate. She becomes anxious before every trade. She starts taking profits earlier and earlier, closing trades as soon as they show any gain at all, just to push that win rate percentage up. She needs to see more green, more wins, fewer losses, because in her mind, 60% losing means she is failing at this. But here is what Sarah had not looked at. Her average winning trade had made $300. Her average losing trade had lost $100. Run that math. In every 100 trades, she wins 40. 40 multiplied by 300 is $12,000 in gains. She loses 60. 60 multiplied by 100 is $6,000 in losses. Her net profit across 100 trades is $6,000. Sarah was profitable. She had a working system, and she had absolutely no idea because she was measuring herself against the wrong standard entirely. Why it happens psychologically. This belief comes from somewhere very specific. It comes from school, from childhood, from years of being evaluated on a scoring system where 60% means below average, where 70% is barely passing, and where you need to be right most of the time to get a good grade. That framework is so deeply wired into us that we carry it into trading without ever stopping to examine whether it belongs there. But trading is not school. The grade you receive on each trade is not fixed at one point. A win can be 3 times the size of a loss, or 5 times, or 10 times. The win rate, taken on its own, tells you almost nothing meaningful about whether a system is working or not. It is one number out of context, and one number out of context is not information. It is noise. There is also a deeper psychological trap at play here that makes this belief hard to escape. High win rates feel good. Winning frequently produces small, regular hits of positive emotion. The brain loves that. And so traders unconsciously start designing their behavior around producing wins, not around producing profit. They cut winning trades early to lock in gains and boost their win rate. They let losing trades run a little longer, hoping they will turn around and not become a loss. Over time, this creates the exact opposite of what works: small winners and large losers, while also producing a high win rate that feels reassuring. The emotional reward of winning often is real, but it is costing them money in the background. They feel successful while their account declines. That is one of the cruelest traps in all of trading. Ask yourself honestly, are you trading to feel good, or are you trading to grow your account? Because those two goals often require very different behavior. The fix. Sarah did not need to win more often. She needed to shift what she was measuring. She needed to stop looking at win rate as the primary indicator of whether she was doing well and start looking at what traders call the reward-to-risk ratio. This is simply the comparison between how much you aim to make on a trade if it works versus how much you accept losing if it does not. A reward-to-risk ratio of 2 to 1 means that if you are right, you make $2 for every $1 you risk. A ratio of 3 to 1 means you make 3 for every 1 you risk. With a 3 to 1 ratio, you only need to be right on about 25% of your trades to break even. Anything above that is profit. At 33%, you are in positive territory. At 40%, like Sarah, you are doing well. The adjustment Sarah needed to make was not about her entries. It was not about finding better setups. It was about stopping herself from closing winning trades too early. She had been cutting winners short to feel the emotional satisfaction of booking a win. That habit was destroying her edge. Once she recognized it, she stopped doing it. She held her winners to her original target. She kept her losses at their defined level. She stopped chasing a high win rate and started chasing a healthy reward-to-risk ratio. The result was that the same trading approach she had been ready to abandon produced consistent profits once she stopped sabotaging it. Her 40% win rate, which had felt like evidence of failure, turned out to be the foundation of a system that worked. She had been one mindset shift away from success the entire time. You might be in a very similar position right now. You might have a system that is actually working, and you might not know it because you are looking at the wrong number. Before you change anything, check your average win versus your average loss. That ratio will tell you far more about your trading than your win rate ever could. Let me bring this together for you clearly and simply. The first lesson from today: cut your losses and let your winners run, is not wrong advice, but it is dangerously incomplete advice. Without a defined target, without a destination that you commit to before you enter, the phrase becomes an emotional trap. You hold winners hoping for more, you watch them give back everything, and you close them frustrated. Fix this by deciding exactly where your trade ends before you enter it. Know your destination. Plan it when you are calm, and then hold to it. The second lesson: more trades is not more opportunity. Overtrading is one of the most destructive habits in retail trading, and it is driven almost entirely by boredom, urgency, and a false sense of what it means to be active and productive. Fix this by trading less. Set a ceiling. Build a checklist. and learn to sit with stillness on the days when there is nothing worth taking. A day with 0 trades is not a wasted day. A day where you protected your capital by not forcing bad setups is a very good day. The third lesson. Win rate is not the right measuring stick for a trader. Winning 60% of your trades while taking small profits and large losses will drain your account steadily and give you a false sense of competence along the way. Winning 40% of your trades with a 3-to-1 reward-to-risk ratio will build your account consistently and give you a real foundation to work from. Stop measuring yourself like you are in school. Measure yourself the way the math actually works. These 3 ideas are not complicated, but they are ideas that almost nobody explains fully when they first hand you trading advice. And that gap between advice that sounds good and advice that is complete is where the vast majority of trading accounts meet their end. Marcus turned his account around. Daniel stopped exhausting himself and started seeing consistent results. Sarah discovered she had a working system she had been about to throw away. None of them found a magic indicator. None of them bought a secret strategy. They understood the psychology behind what they were doing wrong. They fixed one thing at a time, and they gave their trading a chance to actually work. That is available to you too. Pick one of these 3 lessons, the one that felt most familiar as you were watching. Apply it for 2 weeks with genuine commitment. One change, 2 weeks. Then look at your results and see what happened. If this video shifted something in how you think about trading, hit subscribe. Every week I put out videos exactly like this one. No indicators, no signal services, no get-rich-quick promises. Just the real psychology and mindset work behind trading that actually holds up over time. And next week, I am covering something that very few traders want to admit to themselves. There is one specific mindset pattern that causes most account blowups. Not one bad trade, not bad luck. A pattern that builds slowly and quietly over weeks and months until the damage is already done. By the time most traders recognize it, they have already lost more than they needed to. I will show you exactly what it looks like and how to stop it before it gets that far. I will see you in that one.